Hello investor and trader, welcome back to a new series. I titled this video Stock I Am Buying. So I already bought the stock, so now I'm making a little recap about it. So before I get started, I'd like to disclaim I am not a financial advisor or a stock guru or claim to be one. I'm just a random guy on YouTube, like to trade stock and invest in the stock market. So let's get straight into it. So before I get started, I would like to say that every investor invests differently based on the criteria, based on the metric, right? If you watch any of my day trading live video recap, I trade like a chicken. I take forever to make a move, right? I need to wait for confirmation, reversal, so on and so on. Well, for investing, it's the same thing. I also have my own criteria. I don't just look at your other YouTube video, especially top 5 stock to buy in the month of December, whatever month it is. That's not me. Maybe other millennials do that, but I don't do that because I like to do thorough research before I decide to buy that company. So here, I'm going to show you guys some of my criteria. Again, these are my criteria, okay? Not your criteria. You need to have your own criteria because like I said, each investor invests differently or they use different metric to determine is it a buy or not. So these are the stuff I look for. So let's just go straight down the list. So the first thing is the question, is the stock in the Dow or the S&P? For this stock, Best Buy, yes. Best Buy is in the S&P. What is the market cap? Now, the market cap for me is very important because it determines other metric. Is the stock undervalued or overvalued? Because sometimes you can have a market cap, like a big market cap, like $1 trillion market cap. I don't make any jokes, but then the revenue is like, what the hell? Are you kidding me? You know what I mean? Because it's over inflated or hype, in other words. So the market cap for Best Buy is 24 billion. So these are the resources that I use. I use 4 different resources. One is Focus Guru, another one is Finvis, and another one is simfin.com. Pretty much, it's all these websites are free. Pretty much all I give you is this bunch of data. That's all it is. And the last one, investing.com. So these are the 3, 4 websites I use just to see some metric. Okay, so let's go to Best Buy here on Finvis. You can see the capital right there, or the market cap, sorry, market cap. Pretty much easy to calculate. All you gotta do is take the outstanding shares, this number, multiply this number, the share price, the current share price, you will get the market cap. So Best Buy is a 24, $23 billion company. Not a big company, not a small company. It's like mid-cap size. So then this is the financial part. So let's just get straight to it. So for me to invest in a company, I like to see 5 to 10 years or more. The more data, the better, right? Has all these got to be increasing: revenue, net income, cash flow from operation or operation cash flow. Total assets must be greater than liability. Conservative debt to cash ratio. I don't want a company that has too much debt. Strong balance sheet or like or a good pile of cash. High return on equity, and also do they pay a dividend? Now a dividend is very important because some company pays a very nice dividend, but they don't have the cash for it. So you better be careful. You need to make sure that they have enough cash to pay for the dividend if you are a dividend investor. We can learn all about this based on these 3, 4 sources. So I'm going to use a simple one. I'm going to use Guru Focus, which gives you a bunch of bar graph, or you can go more of the hard data is using this right here, SimFin. So this is free. Again, it's free. They give you like a decade of data, and you can go through the balance sheet and the financial statement and stuff like that. So that's for me. I'll make it easy. I don't make it complicated. Of course, I use all of them, by the way, but it's just to give you an example, right? For visualize, just visual, it's much easier to see visual than a bunch of numbers and letters, right? So you can see here, revenue is increasing, but it's increasing very slow. Again, it's a retail store. It's not like a software company where the revenue skyrocket like Facebook. So it is increasing, but very slow and steady. Same thing for the net income. They are making money, but very little because the profit margin is pretty low. So that's why I go here, and you can see all this stuff right here: gross margin, operating margin, and profit margin. You see the profit margin, right? It's pretty damn low. So in other words, $100, they're only making like $5. So low profit margin business. Okay, cash to debt. You can see, looks like they have more cash than debt, right, for the past 5, 10 years. That's a good thing. I do not like it when a company has too much debt because it's very scary when hard time comes, like the coronavirus or a downturn of the economy, a recession. Company with a lot of debt can go bankrupt. Now, this is very important right here too. Cash flow from operation or operation cash flow, free cash flow, net income, and from the dividend. As you can see, for the past several years, is increasing. Also, dividend down here is also increasing, so it's a good thing. So they have enough cash to pay for their dividend because look at the cash flow. It's over 5 billion. Now you may ask how much the dividend. It says right there. So the company pays $568 million. So they have plenty of cash to pay for investors. And if you go here, you can see this is this is earning. Let's go to the dividend. Again, that's why I have many different sources for different purpose. For this source, I'm going to see the dividend. See if they're increasing or decreasing. So these are quarterly dividends. Let's go down and down based on just a bunch of history. That's all it is. So 13 is fine, right? So you can see 17 cents, 17, 19. Now this, I think this is a special dividend, I think, because it just jumped pretty drastically. Then 20, and then another big one right here. So it looks like once in a while they do like a special dividend or something like that. But in general, the dividend is increasing, so that is good. Another way to look at it is what is the payout ratio? Are they paying out too much or too little? But they are paying, I think, a little too little, which is good. That means they have enough cash to increase their dividend over time. Very good for the shareholders. Now here's the percent ratio. So right now the current price is at 97. You take $2.80, divide this number, give out the yield, which is around 3% right now, which is pretty damn good. 3% return. That's better than a saving account. So let's go continue down the metric. Oops, wrong one. Sorry. There we go. Okay, strong cash, yes. High, yes. Dividend, yep. Okay, now the PE ratio. Now this is a retail, okay? So retail tend to have, well, it depends what kind of retail it is. It can have high or low. But the low one, the S&P average right now is like mid 20s or high 20s or even in the 30 because the overall market is kind of expensive. But for Best Buy, it's only 9.44 or 9 or 10. So it's pretty cheap, pretty low compared to their competitor. Let's go to like Walmart, for instance, right? Walmart is a good one to compare the PE ratio because it's also known as retail right here. Walmart is 48, like almost like 3 times more. So let's go to another one. Costco is a good one, right, to compare. I'm just comparing ratio here. The PE, not their business model, because their business model is a little bit different. PE right here is pretty high, as you can see. So kind of give you an idea. Okay, Best Buy PE ratio is pretty cheap. All right, so let's go to the next metric. Price to sale under 10. Well, I prefer under 10. So obviously, this is like less than 1. As you can see, the market cap is around 24 billion, but they're doing 52 billion in sales. Very, very good. So I like that a lot. Because sometimes you would see a price to sell like crazy number. Like, I'll give you an example right here. Like Zoom, for instance. Crazy sell to market cap number. Oh, they drop a lot. Oh, well, now it's 13, but before, when the stock price was at 200, 300, 400, 500, 600, whoo, this right here is a crazy number, and you don't want that. You want the lower the number, the better. Ideally under 10, but I can see for Best Buy is under 1, which is very awesome. Damn, all these ads, man. Yeah, again, I'm using free stuff, so they give me a bunch of ads. Kind of annoying, but it's okay. All right, let's go to the next metric. Why economic moat? Well, not really. I mean, they have a lot of competition, so this wouldn't apply to it. But other than that, it looks pretty good compared to other metric. Share dilution. Nope, they are buying back their shares. You can find out right here on Finvis. So they are buying back their shares. You can see the years right here, 2020, 2021, and the future. So it's decreasing. So that's good. Or you can go right here And it tells you, I think it's under the balance sheet or cash, something like that. Let me find it real quick. Again, there's many sources for you to verify these numbers. There we go. Cash from purchasing repurchased equity. So there we go. So they're buying. So these are the number of in this is million, this is billion. How much they buy back their shares. So they are buying back their shares. That's a good thing. That means that's good. It's just good for shareholders. Because I do not like shares. I do not like companies that dilute the hell out of the shareholders, especially growth stock. But they do it for a reason. They're trying to raise capital, so it's understandable. But not to the point where they abuse the system. Like one company I can think of is Workhorse. Look at they dilute the hell out of the shareholders. It's pretty sad. All right. Okay. Now the technical is it uptrend or downtrend? Notice I said weekly and monthly. I do not use daily here because, like I said, for investing you want to see the overall picture. So let's go to the chart. Weekly chart for the past 10 years. Well, it was like what, 10, 20 bucks back then. Now it's 90. So it is an uptrend on the weekly chart. The monthly chart is no different. It just gives you a cleaner looking chart. Clearly an uptrend. That's important because I want to see the overall direction of the stock is going. All right. The next criteria. So when is the time to buy? So these are the 5, I would say, time to buy when the stock is in trouble. Temporary bad news, like nah, I don't want to make any bad example. Just temporary bad news. Overall stock market correction, sector rotation, missed earnings, or it's just that sometimes the stock just sell off. Just pull back to the daily 200 moving average. It's just temporary news, but the fundamental remain the same. That is when you buy the stock. So before I get more detail, you can see here, just on chart, right? During 2018, or even right here, the 13-14 time. So you can see, let's just start from here. So the stock was 40 bucks, around 40, and it tanked all the way down to 20. That's a 50% drop. Okay, so that's the first one. Well, based on the 10-year time frame. Here's the second drop. Another word, sometime Best Buy will drop 30 or 40%. So it's nothing new. See, same thing in 2018, from 80 all the way down to 50. That's over 30% drop. And then it did again during the coronavirus drop. Now it's doing again. Now let's go to the data. You can see the big drop right here. See? From 140 down to 90 or 95. That's a 30+% drop. So it's nothing new. So as an investor, you should see that as an opportunity to buy. All right. So I think I've gone over the whole criteria, some of the criteria here. So let me show you guys the footage that I did today. So you can see I have an order right there for Best Buy. I use option instead of buying the share directly because I use cash secure put. Now what is cash secure put? It is right here. This is the definition, a screenshot. It says you are being paid to buy stock that you want to buy at the price you want to pay for the stock. Kind of redundant, but all it's saying is you are getting paid to buy a stock at the price you want. All you gotta do is just wait for it, because option has a date known as expiration date. So let me go to that, give an example. So here is Fidelity option chain. So this is what it looks like on the platform. If you use a website, it's a little bit different. So on this video, I'm going to use the platform. So pretty much put is saying that I am agreed to buy the stock at whatever price you want and whatever day that you want. So the sweet spot for me is around a month or a month and a half period. That is why I selected January 28th, which is down here. Right here. And I selected 97, pretty much in the money. First of all, one is I like the premium. It's pretty damn nice. Secondly, I do not mind at all to own the shares at $97. You have to be comfortable what price you want to own it. Some people want to own at 90. Some people want to own at 85. But the farther away the premium, sorry, the farther away the price you want to buy, like lower, notice the premium is getting less and less and less. So it just depends what price you feel comfortable owning the shares. For me, I did 5 contract, meaning I want to buy 500 shares, initial investment, 500 shares, and then I want to buy at 97. The word P meaning put, pretty much this right here is referring to this right here. And you just fill out your orders. So just go here, and I give you these options. So you want to select sell to open, not buy to open. Buy to open meaning you're buying a put. It is much different than selling the put. I am selling the put, so make sure you select sell to open. Now I did cash secure put. Again, it is different than selling naked put. So please understand the difference. It's not the same. Because you sell naked put, if the stock price hit below 97 on this date right here, you are forced to buy 500 share or whatever number of contract you want to have. So some people do naked put and they get screwed. They get margin call and stuff like that. So make sure you use cash secure put. And again, do not go all in. When I buy a stock, I like to buy an increment. So I'm very comfortable with 500 shares initial. Alright, so let me minimize this chart. That's okay. Go back to the video. Where's the video? There we go. Alright, so let me pass forward. There it goes. Once the stock starts tanking, I got filled. So I got filled at $3.75. So I am going to collect $3.75 per share, and I have 500 shares. So let me go to the Excel sheet to show what I mean by that. So this is what the screenshot in the website of Fidelity looks like. So it said I am going to collect $1,871. So pretty much is, if I do get a sign, my average cost is going to be $93.25 instead of at $97 because of the premium, which is pretty cool. And then once I get a sign, oh, this is a different one. This is wrong data. This is copy and paste from a different contract. So once I get a sign, I can do cover calls, known as the wheel strategy. So yeah, this is stock I just bought. But that doesn't mean you go out there and buy it too. You have to do your own research, do diligently, right, to make sure that this investment is for you, that fits your criteria. Again, it fits my criteria. That's why I decided to buy Best Buy. Okay, see you guys in the next video. Bye.